That's not going to make sense until we get to the proper time. But moving down, my assumed valuation date, just like it was when I did my comps and my precedent transactions approach, assumed valuation date is December 19th. My revenue growth for these next 3 years, I'm assuming Kraft is going to grow revenues about 5% a year. So you'll see that input into the model. This is hard-coded. And as we get into modeling, you'll see that when we put in assumptions, we typically enter them as hard codes. That way we can come back, make a change to our assumptions in one place, and then it'll flow through the rest of our model. All right, so this is hard-coded as it should be. I'm going to assume an EBIT margin of about 11%. And these are consistent with what Kraft's done historically. I'm not going way out on a limb and saying they're going to radically increase their profits or grow their revenues at a rate that they haven't achieved in the last few years. So these are based on my having done a little analysis of Kraft first. 5% revenue growth, 11% margin. At the EBIT level, I'm going to assume a 35% tax rate. Depreciation, amortization is a percent of revenue. We're going to assume 2.5%. We're going to assume that they're going to spend 3% of revenue as CapEx. And we're going to assume that their working capital as a percentage of their incremental revenue growth is going to be 10%. I'll show you how I use that in a moment. That'll give me an estimate how much money Kraft needs to invest in working capital. Okay, and then there are some assumptions down here. Let's ignore these for the moment. We'll come back to these when we get into the actual DCF itself. First thing I need to do, though, is I need to fill out my projections. So I'm going to start here in 2010. All right, so year one, or 2010, I need to estimate revenues. And again, my assumption is that revenues are going to grow 5%. So what I want to say is equals last year, or F9, times, open parentheses, 1 plus my growth rate. So I say 1 plus, and I'm going to scroll down, and I want to highlight cell Q23, 5% revenue growth. Before I hit enter, though, or before I close that parenthesis, I want to do something called locking on the reference. And this isn't a finance term, this is an Excel term, because I'm going to want to copy this formula across. If I don't lock on the reference, that is, set the formula up so that no matter where I copy it in my worksheet, it always refers to this. If I don't lock it, then as I copy it 1 to the right, it's going to refer to the cell 1 to the right. And in that cell 1 to the right, there's text. There's not a growth rate. So the way I want to lock on this is I want to hit F4. And you'll see that when I hit F4, it puts a $sign both in front of the column as well as in front of the row number. And that's how you can tell that the cell is locked. Now I can close my parentheses, and now I can copy this. Control C to copy. I select the range where I want to paste it. Control V to paste. All right, if you're not familiar with Excel, if you're not familiar with the shortcuts, starting tomorrow I'm going to start writing these down on the board. So all the little keyboard shortcuts that I use, F4 to lock, Control C to copy, Control V to paste, I'm going to keep a running tab of these. But at this point, just kind of familiarize yourself with the terminology. So I have revenues. Next item I need, and again, these items, I'm capturing these, I'm forecasting them so I have enough data to calculate free cash flows. I need EBIT. And like I said earlier, my EBIT I'm going to calculate as a margin on my revenues. Every year it's going to be 11% of revenues. So in each year what I want to do is say equals revenues. So in 2010 equals G9 times that margin, Q24. All right, so take 11% of revenues in each year. But again, before I copy this across, I need to lock on Q24, otherwise this calculation won't work. So again, to lock, F4, and I can copy that to the right. Next item I need, D&A, depreciation and amortization. And as we recall, we're going to calculate this as a percentage of revenue. When we talk about forecasting a little more tomorrow, you can do this based on depreciation schedules. This can be a very complicated calculation sometimes, but here we're going to keep it simple. Simply multiply each year's revenues by that assumption of 2.5%, which is in Q27. Just like before, I want to lock on that. F4, copy that across. Next item I want to calculate is actually EBITDA. You'll notice there was no assumption for EBITDA over here, because there doesn't need to be. If I make an assumption about EBIT and I make an assumption about D&A, I'm calculating the two components of EBITDA and I just need to add the two together. And actually, if I look at cell F12, which is just to the left, that cell's already taking that calculation into effect or into account. I can actually just copy and paste that across. So rather than retyping the formula in cell G12, I can copy F12 across. Control C to copy, Control V to paste. And you'll see that now we've got EBITDA in the last 3 years of our model as well. Now EBITDA is not directly part of the free cash flow calculation. Where I'm going to use EBITDA in my DCF is when I calculate that terminal value. Remember, I'm going to calculate terminal value by multiplying year 5 EBITDA by a multiple, so that's why I've captured EBITDA up above. Next item I need, CapEx, capital expenditures. Here's where there's a little bit of a twist. Okay, CapEx is a source or a use of cash. It's a use, right? It's cash that the company, it's an outflow of cash from the company. It's money the company needs to spend every year. Think of it as the company having to write a check. Because it's a use of cash, we want to show it as a negative, as an outflow of cash, similar to how it would be represented on a cash flow statement. So here, instead of saying equals revenues times 3%, I want to say minus revenues times 3%, and the result will be a negative, as it should be. Does that make sense? So I want to say minus G9 times, just like before, I'm going to scroll over to column Q, grab my CapEx assumption, which is in Q28. I'm going to lock on that and copy it across. So we list it as a negative for two reasons. One, it's a use of cash. The second reason is when we put it into our free cash flow calculation, if you add a negative, it will automatically subtract it. Right? So it's a little easier in that regard. And then the last item I need, my working capital requirements. And recall earlier when we talked about the assumption for working capital, we said that working capital requirements are going to be 10% of incremental revenues. That is, if we take a look at how much revenues have grown by between this and last year, we would then multiply that difference by our 10%. We're also, because it's a working capital requirement, as companies grow, they tend to have to invest in working capital. It's also a use of cash. The cash will be tied up in working capital. We want to reflect that as a negative. So the way I want to phrase this is I want to say minus, open parenthesis, this year's revenue minus last year's. Remember, this is incremental revenue, times my working capital percentage at 10%, which is in Q29. I also want to lock on this, and I can copy that across. Don't get too concerned. The reason I want to do this and have you watch, I really just want you to listen to the methodology, listen to some of the shortcuts being thrown around, and get familiar. Make sure you understand the concept. You'll get to do this as practice for homework tonight. And then tomorrow we're going to be very hands-on. We're all going to be working in Excel building a model. All right. So if you've never done this before, just listen along. If something doesn't make sense conceptually, make sure you ask a question because we will start doing this tomorrow. At this point, I have everything I need to calculate free cash flows in each year. All right. So I've done step one of my model. I've forecasted what my free cash flows are going to be. Now I need to capture them down here in my DCF, my actual DCF model. Let's take a look at what this model contains, just so everybody's on the same page. Each year, we're going to show what the revenues are, really just to give an illustration of how quickly the company's growing. And then down below, we're going to actually calculate free cash flow using the inputs that we just calculated above. So EBIT, less taxes, less CapEx, less our working capital, plus our D&A. Same formula I put up on the board earlier, same formula that's in your slides. All right, so that's actually a formula just like the enterprise value formula. Commit that to memory. If you go and start interviewing at an investment bank, chances are someone's going to ask you how to calculate free cash flow. It's an integral part to the DCF analysis. You should know that. And actually, the way I've set up this model is I can actually just copy the contents of column F. I can just copy them across. Because if we look at the cells in column F, it's just linked to the numbers up above. And if I just copy those links across, it should give me the numbers that I need. So here I'm going to select all of the numbers in the DCF section of column F, Control C to copy. I'm going to select my range from 2010 through 2012. That's where I want to paste these. I Control V to paste. Just a quick and dirty, or quick way of doing this without having to type in all the formulas. But again, all these cells are doing, they're basically just linked up to the numbers above. With the exception of taxes, taxes are being calculated as a percent of EBITDA using that 35% tax rate. And if you want to ask the question, where is free cash flow? It's right here. It's right here on this row 34, cells E34 through I34. These are the free cash flows, periods 1 through 5. These are the numbers that I need to discount back to the present. And then I'll add that present value, that resulting present value, to the present value of my terminal value, which I'll do in a moment. Let's talk about year one. Let's talk about the 2008 numbers before we go on. Okay, if we look at 2008 relative to 2009, see that the numbers are a lot lower. And if you look at the 2008 numbers in our DCF section down below, you compare those to our forecasts up above, they don't match. Who can tell me why? What is different about 2008 compared to 2009 and beyond? Yeah, think back to the valuation date. We're valuing Kraft as of December 19th, 2008. 12 days before the end of fiscal 2008. Our projections represent a whole year of projections. But if I were to come in as a buyer of Kraft, I bought the whole company as of December 19th, 2008, the only forecast that I get the benefit of is from that period, from December 19th through the end of the year. I only get the benefit of 12 days worth of revenues, 12 days worth of EBITDA, 12 days worth of cash flows. And that's what that stub period is intended to represent, the portion of the year that remains. Because in 99.9% of the situations, you're not going to be valuing a company right as of January 1st and have the whole year ahead of you for your first year. Chances are your first year is going to involve a stub period, and so you need to account for that. And the way we've done that, if we go back to our assumptions, now we can explain this calculation. Our stub period basically takes the difference between these dates, the difference between our fiscal year end and our valuation date, only in the first year, because if we buy them as of December 19th, 2008, we'll get those 12 days of 2008, but then we'll get a whole year of 2009, and 2010, 11, 12. So it's only in this first year. We take the difference between the dates, and Excel has a nice function where you can actually add and subtract dates. So you can take two different dates, subtract them, it will give you 12. We divide that by 365, and the stub period expresses in percentage terms how much of that year is remaining. And once we have that stub period, in this case 3.3%, every line item in our 2008 column for our DCF is multiplied by that 3.3%. So we take revenues, full year revenues times 3.3%, full year EBIT times 3.3%. And that tells us, that approximates what percentage of those cash flows remain. All right. That's a pretty simplistic assumption in a seasonal business like a retailer. If you buy a retail company on September 30th, 2008, right before the Christmas season, you're probably going to get most of their cash flows. Okay, so if you're doing this with a seasonal business, you'll want to adjust. You'll want to have an understanding of what percentage of cash flows they generate during what portion of the year. In this case of Kraft, we just did a straight up assume that basically every day gives a certain percentage of cash flows. 12 days comprises 3.3% of the full year. And then for each successive year, it's just the full year number is taken from above, straightforward. And now we get down, our free cash flows for each year, again, are in row 34. Now all that remains is we need to express them in present value terms. That is, we need to discount each cash flow back to the present. Remember that time value of money formula we went through before on the board? That's where the time value of money is going to come into play. All right. Let me put the time value of money formula up here just so we've got that as an example. Remember what I said earlier, if we were solving for present value, we take future value, we divide by 1 plus the discount rate raised to the nth power, the future value in time n. Okay, another way of saying this in a DCF context, free cash flow, year n, divided by 1 plus r, WACC, raised to the nth power. All right, just our time value of money formula we went through before. The question is, in each year, what is n? The first question anyway, what is n? In this model, we're actually going to take a simplistic approach. We're going to assume that all cash flows come at the end of each period. So in year 1, n would be equal to what? Expressed in terms of the proportion of the year remaining. In year 1, it would be equal to the stub period, 0.03. Actually, I think it's 0.033. Okay, so I'm going to say in year 1 equals Q20. And then each year beyond that, we're just adding a year to it. So at the end of year 2009, it's 0.03 plus a full year, so that'll be 1.03. So we'll just say each year equals the prior period plus 1, and we can copy that across. Now in reality, companies don't generate all their cash flows on the very last day of the year. Okay, I know that. In general, in banking, a lot of times what you'll use is something called a mid-period discounting convention, basically assuming that companies generate, on average, their cash flows halfway through the year. All right, so you